The most negatively correlated asset to gold is the stock market. So if the stock market's making new highs, doesn't mean gold should be making new lows, but it does imply that gold shouldn't be doing as well as it is. So if gold is doing this well in a stock market that's also doing well, it's indicating to me with all my years of study that we're really going to see something on the next major leg up because gold is forecasting. Markets look to the future that there's a lot that's going to take place in the next, I would say, few years regarding the precious metals.
Gold has outperformed the broader U.S. stock market this year, and Wall Street is turning more bullish on the precious metal as the Federal Reserve gets closer to rate cuts. Bullion has jumped about 21% in 2024, while the S&P 500 has climbed 16%. On Friday, gold shot up as much as 2.2% to a fresh record high, exceeding $2,500 per ounce. Gold is an asset that many like to own for inflation protection. Rising prices tend to erode the purchasing power of a currency like the US dollar, while gold generally increases in value over the long term. David Morgan, a renowned expert in precious metals, draws from decades of experience to highlight the critical signals in the gold market. He asserts that when gold reaches new highs, even in a robust stock market, it indicates that major shifts are on the horizon for precious metals. Morgan explains that the rush to gold typically starts gradually, evolving from a slow walk to a brisk jog, and ultimately culminating in a full sprint, as investors increasingly favor gold over traditional assets like real estate, stocks, and bonds. In fact, central banks have been a top source of gold demand as countries like China, Turkey, and India look to diversify their reserves away from the US dollar, especially since witnessing the West freeze Russia's dollar assets in the wake of its Ukraine invasion. According to J.P. Morgan's estimates, central banks purchased over 1,000 metric tons of gold last year. The People's Bank of China went on an 18-month buying spree, its longest ever run of purchases, that finally ended in May. And in June, India's central bank boosted its gold reserves by the most in almost 2 years. Morgan reflects on history, noting that in the 1970s, around 5% of global wealth was allocated to precious metals during periods of currency crises. In contrast, today's data shows that only about 1% of wealth is invested in metals. He suggests that if this allocation were to return to the levels seen in the 1970s, it could trigger a significant influx of new capital into the precious metals sector. Let's delve into the video to gain further insights. Before we begin, consider subscribing to the channel and hitting the bell icon to stay updated with the latest content.
Well, price establishes that it's true, but no, it's central bank buying, really. I mean, they've been kind of the underlying force that no one looks at. I mean, I talk about the run to gold many times, might have done it on our last interview, but the run to gold starts off as a, slow walk and then a regular walk and then a brisk walk and a slow jog, a full jog, a fast jog, then it goes into a run, then it goes on an all-out sprint. And it goes on an all-out sprint. It's when everybody everywhere decides to rather have gold than the real estate or gold than, stocks or gold in the bond or gold. Everybody's rushing to get into gold. And of course, that's approaching the top, and that's when you want to let sell it to them. We sell it for paper. Well, maybe not. We'll address that in another interview, but that's the idea. So right now, I would say we've just started to walk. The banks have been picking it up in almost stealth manner, unless you follow the gold market like you and I. Most people are unaware and don't really pay attention to because they don't really care. They're too busy working and paying their bills to worry about what the gold market does. But nonetheless, the facts are there, and it will accelerate. I mean, reason, and the other one's price. I mean, when you got a new nominal high in gold and it's knocking on the door when the stocks are high, you got to remember this is important. The most negatively correlated asset to gold is the stock market. So if the stock market's making new highs, doesn't mean gold should be making new lows, but it does imply that gold shouldn't be doing as well as it is. So if gold is doing this well in a stock market that's also doing well, it's indicating to me with all my years of study that we're really going to see something on the next major leg up because gold is forecasting. Markets look to the future that there's a lot that's going to take place in the next, I would say, few years regarding the precious metals. How many big names with huge positions, such as Buffett, dumped so much of their Apple stock, or other entities, Jeff Bezos, Jamie Dimon, Zuckerberg, all these people that are in the know that are dumping the stocks. Well, that's an indicator, people. They're getting out because they can. They're trying to get out as near the top as they can. And so then where do you go? Real estate isn't going to work. Stocks are shifting from a neutral to a down position. The bond market, good luck and longer term. There isn't a lot of asset classes to go to, and of course, the precious metals is one that's been overlooked for a very long time. So if that big money, those superstars, start moving, portion into the metals, then we really have something that could be, rather breathtaking over the next few years. And I say that with some authority, but go back to the 1970s. No one has the exact numbers, but purportedly the amount of wealth that was into the precious metals in, say, 1970 in the 70s was about 5%. Right now we have better metrics because, we spy on everybody doing everything. And we have a little over 1% in the metals markets. So if that went up fivefold and reestablished itself like it did in the 70s when people were very concerned about a currency crisis and the demise of the dollar, which obviously never happened, then we could see a lot of new money coming in. So is this the start of a flow, or are you just starting to turn the pressure on the fire hose and you're very, very far from opening it up all the way? I don't know. That's my metaphor. I think that's the case. And, the data will have to back me up. But I've seen it start. I mean, it's undeniable that it started. Whether it'll continue or not remains to be determined.
The Federal Reserve is expected to cut interest rates next month, adding to the appeal of gold. Treasury yields have mostly fallen broadly as investors anticipate a rate cut in September. Usually, gold is sensitive to interest rate moves because they can affect the alternative cost of holding non-yielding bullion. The CME FedWatch tool indicated a 100% probability of a rate reduction in the upcoming September 18th meeting. The likelihood is split between a 25 basis point BPS cut, favored by 75% of market participants, and a 50 basis point cut, supported by the remaining 25%. David Morgan predicts that gold might initially decline when the first rate cut happens, potentially as early as September. He believes that gold could drop that day because the market had already priced at the rate cut. Morgan recalls a past instance where, despite a geopolitical event that would normally drive gold prices up, the metal actually fell, demonstrating how markets can sometimes react contrary to expectations. Now, let's redirect our attention to a video.
I've learned many things the hard way, and it's probability. I mean, it's not like 100%, but one of the things that I learned fairly early was that markets look forward. They see the future. And so I think the first, rate cut that we're going to see after some time, maybe in September, probably likely in September. I think gold will ignore it. And I think gold may go down on that day because I think gold's already anticipated. I remember one time, trading gold. I used to trade futures quite a bit. I don't do that too much anymore, but I was long gold, and there was some, war thing going on. This is, 25 years ago or whatever. And yet gold went down, and I called my account manager or my broker, and I said, "What's going on? I mean, this should be positive to gold." And kind of explained to me what I just said. The markets anticipate gold saw it coming, and people are selling into the rally or selling it off. So that's my take. I mean, but longer term, the monetary crisis continues, and the other asset classes are, doing well today. May do well to the end of the year. I don't know, but the real facts are what we talked about. I won't repeat too much, but the amount of insiders that have sold stocks, the amount of problems in the real estate market, and big people that are moving from those two realms into gold, not so much for price appreciation, but for price stability or for wealth preservation. And that's what gold exists for. I mean, it's really not going to make you wealthy except in rare occasions. I mean, when there's really a wealth disparity on the price of gold. Now, I'm going to move on from there real quickly, but I wrote an article, one of the guys I work with, that they bought out the Lemuria royalty company I started many years ago. We merged with them, and he's asking me something about the price of gold. And I said, well, read an article I wrote about 25 years ago called Engineering the Price of Gold. I mean, it's how much gold do you have versus how much paper do you have? 25 years ago, The price was $2,500 an ounce. Well, James Rickards just did that same basic math a couple months ago, and the price was 27,000. So that shows you how much paper printing has gone on between the year 2000 and the year 2024. The supply of gold really hasn't changed very much, changed slightly, but the amount of paper has been astronomically increased. So it's a moving target. I mean, the one thing I don't think the public understands is the price of gold going higher doesn't mean that gold's really gaining in value. It's maintaining purchasing power. The dollar's being destroyed. That's what they don't understand. But if you live in India, you understand it. If you live in Argentina, you understand it. If you live in almost any South American country, you understand that. It's like a basic thing that you probably know when you're a 6-year-old kid, because these governments always destroy the currencies, and they do it fast enough where you can see it. Whereas the United States, having the reserve currency status, has done it slowly enough over time that the boiling frog it's boiling now, and it's a little bit late to be jumping out of the pot.
The general trend of gold price is still strongly bullish, and breaking the psychological resistance of $2,500 per ounce is enough to push all technical indicators towards strong overbought levels. However, considering that the continuation of its gains factors in light of investors abandoning risks, the weakness of the dollar, and further easing of global central banks' policies while increasing their purchases of the metal will ensure some upward movement. Furthermore, if the dollar recovers and geopolitical tensions calm down, gold prices may be exposed to profit-taking sales. Do you think gold will continue to be seen as a reliable store of value in the face of evolving economic challenges? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up, and remember to subscribe to stay updated. Thank you for being a part of this journey with us.